let's start it off. Would love to kick it off with a little bit about you guys. We can pass it down, we'll go down the line. Why'd you get into VC? Why'd you stay in VC? And what is the most exciting thing that you've done in the last year?
Oh my gosh. So I was in college that I thought I was going to be more on the founder path. And I didn't really know much about venture capital. And then I was invited to participate on a founding venture capital firm run by students at the University of Chicago. And I just kind of fell in love with it then. And that is how, ever since then, I've been on that VC career path and focused on that opportunity. I loved working with founders on what the future could be. They're building out new products, new technology, new businesses, and that's what I wanted to spend time with. And I always thought that founders kind of were the most interesting people to kind of spend time with and kind of dedicate a career towards. So that's what got me hooked. The second part of the question was?
What made you stay?
So what made me stay? I specifically saw an opportunity to invest in founders kind of outside of the coastal hub. So we invest in the Midwest, and I'm based here in Chicago. And that was really attractive to me early on, and I think has since been validated by just seeing so many successful tech stories come out of this region that, it'd be hard to continue if I wasn't seeing that, but I'm seeing like the fruits of, the efforts of all the founders and people that we backed, and so that's kept me really engaged. And then the most exciting thing I did in the past year, that's
Other than this panel, obviously.
Other than this panel, I would say I've had an opportunity to be one of the within venture capital. I've gotten to participate in a group of a fellowship group called the Kauffman Fellows, and so every year I get to go on their international trips, their summits. And this year was in Mexico City, and that was a very exciting time. I got to see and connect with that ecosystem, which has differences and similarities to Chicago and the greater Midwest, and just spending time in a new market and then with friends in that kind of exciting area of the world was one of the most exciting things that happened to me.
Yeah, I think I also kind of thought I might have been on the founder path initially. I used to be a software engineer for a couple of years, and I think honestly, I didn't end up going that route because I just could never really find that one idea that I was passionate enough about to sort of throw all my weight behind. So to me, VC is kind of like the next best thing. I get to help support those founders who do really have that passion. So that's kind of why I got into it. I think why I've stayed is it's just endlessly intellectually challenging and stimulating. You just always have something new to learn, kind of similar to programming. There's always like a new framework for you to learn. So I think that just really keeps me going. And then I think, one of the most exciting things I got to do in the last year, at least in a work context, was I actually got to invest in a company that was started by a former colleague at Touchdown Ventures. So that was just really gratifying because I had come to know what a great leader he was directly from working with him for 2 years. And then he left to start a company, and we actually got to back him as investors. So that was just a really satisfying experience.
That's incredible.
Yeah, so my name's Ryan. I'm with Storm. I'll keep it really short. I got into venture 22 years ago. I started the fund, so I'm kind of a dinosaur. And I got in because we saw that there's a lot of people investing in things at that time that they didn't understand. It was a lot of bankers and consultants, and it was very financial. And to see where venture has come over the last couple of decades, where I think venture investors come at it much more from a service kind of standpoint and know a lot more about the areas they're investing has been pretty cool. What's kept me in venture, the funds have done well, so it's a privilege there. LPs continue to give us money to invest on their behalf, which is great. But it's also just, I think, the learning. Just take SignalWire and everything about WebRTC and what's happening in the future of telecom. I only spend a small percentage of my day thinking about that, but it's just amazing to spend time with a team that spends their entire day doing that, and it's just constant learning, and I really love that. It makes me insecure most of the time because I'm always not the smartest guy in the room, but that's great. I'd say the most exciting thing, I'll give you something personal instead of professional. I sail a little bit, and we have a small sailboat in San Francisco where I live, and we Myself, a friend of mine, and 2 of my kids sailed to Hawaii this summer from San Francisco, and that was great to finally do that.
If you didn't answer with that answer, I was going to press you on that one.
Okay.
I'm so glad that came through. Because, look, we aspire professionally, but, personal stuff matters, right? And I
Sure.
think that's a big
Yeah.
component of what you guys do when you start talking to and learning more about companies. We're going to get into a little bit of the KPIs and some of the hard numbers, but, it's also about the personalities. It's also about the humans and the founders that you're investing in. So we'll start with the hard numbers, and then we'll work our way back to the people, if that makes sense. So if you want to hold on to the mic, we'll go backwards on this one. We'll talk about what are the what are the things you look for in what a target company is describing as an addressable market, and then what are, other than net revenue retention, what are the KPIs that you really hone in on and that you believe are sort of the unsung heroes of driving success within these companies that you source? And don't have to give away all the secret sauce, but just curious.
Yeah,
to know.
or talk for an hour. So at Storm, all we do, first of all, is B2B SaaS. That's it. So I'm not doing any consumer deals. I'm not trying to send anybody to the moon. We're not doing any deep tech. So it's kind of boring B2B SaaS. And most of the companies we invest in have a little bit of revenue, $500,000 to $1 million in ARR. So we're not doing any seed rounds. We're not doing any pre-revenue stuff. We sometimes do by exception, but it's really not mostly what we do. So those are kind of the high pass fillers. Those are the easy things, right? The objective metrics we kind of look at. Then, I think it's I don't know, a stereotype, I suppose, but market and the team, right? So market for us, I think less about trying to, hey, is it $1 billion market? I think about it more from the standpoint of, can you build 50, 100 million revenue business with whatever the team is doing? Because I have a hard time, these SAM, TAM numbers, they're always like billions and billions of dollars. It's hard to really know what that means in terms of practically the business. So I come at it more from a standpoint of, can you really sell enough into that market to make it interesting? And then on the team, probably the most important thing outside of domain expertise is the ability to recruit. Like, is it a team that can convince other very smart people to join them on the journey? Because no matter, how good you are or how much experience you have, if you can't convince other people to come along with you, whether it's investors or more importantly, other execs, you're not going to go far. Yeah.
Yeah, I would echo everything Ryan said, and I also spent a lot of my time in kind of enterprise SaaS. Touchdown Ventures, we cover many different sort of industry verticals, and we actually look at investing across all stages, but for me, it's more enterprise SaaS, and kind of Series A to C is more a sweet spot. I guess one thing I'd add when thinking about the market, in addition to just wanting it to be big enough, I think it's also like figuring out, is there a real burning customer need for this problem that the company's trying to solve? And so you can kind of figure that out by talking to those customers, but it's also just like figuring out, does this pitch resonate with me? Is this a real problem that exists in the market where you're looking at the company and they can't even keep up with the demand, even if the product isn't perfect yet? Like, I really try to look for that dynamic versus a company that might be like producing a solution that's looking for a problem.
Yeah, so we are a little bit on the earlier side. We call ourselves a pre-seed or seed investor, and that could be pre-revenue. It tends to be the earliest customers, like less than $1 million of annualized revenue, though. So about one stage before probably where Ryan's investing. But our biggest category is B2B SaaS, but we tend to look also. We've done consumer. We've done more, not like SMB enterprise, but also horizontal, vertical, and in healthcare and logistics and other kind of more niche industries sometimes. We are mostly actually analyzing the team, so I know we'll get to that. When we look at the market size, I know that it needs to be big eventually, but sometimes it's nice to have a really concentrated, focused initial target market, and then you can kind of showcase what you can expand into, or how that gets bigger, either by expanding the contract value or the customer profiles. And then, we're looking for like initial hints at like, is this product market fit? Are you making some really compelling sales? How hard is it to make these sales? How fast are you making them? Does it feel like you're getting pulled into the sales process versus It's a very, are you really struggling to make those first sales is kind of where we're at.
All right, lightning round. The unsung hero metric. Just give one. The one that you look for that isn't just, gross net revenue or net revenue retention or churn. What's that one sort of underlying thing that you like to pick out and ping maybe a founder on to say, are you a fit, are you not? And if it's an unfair question, you can say pass. Pass is okay here. We're in the trust tree.
I'll take this before you guys do. There's different metrics for it, but capital efficiency and how much have they raised to get to a certain point. So if a company has, $500K of annualized revenue, but has raised $3 or $5 million to get there, and they're now raising their new round, I'm a little bit, we may not even dig in. Because I don't know if we're supposed to try to be early, so there's going to be some valuation and cram down issues or something like that. But there also could be something wrong, or they wasted a lot of time going down the wrong path or something. So I'll just generally capital efficiency, and sometimes it's a ratio or there's, scores and stuff like that.
Yeah, that's a really good one. The one that comes to mind, I don't know if this is the best one, but the one that comes to mind is just looking at percentage of revenue that actually is recurring versus non-recurring. Sometimes, founders will just talk about revenue high level, and you want to kind of dig one level below that to see how quickly they've gotten. Oftentimes, it's natural to start with a split of like project-based or services revenue and some recurring, but you want to see like a trajectory towards more of a recurring revenue business. So that's one I'd say.
Yeah, outside of the financial metrics, there's a lot of them. I guess I'd give you a kind of a subjective one, which is the ability to tell a story. So it relates to the whole people question, but the best founders in my experience are the ones that can really tell the story about why now, why the business, what the product vision is going to be, where the industry is going. It's not like a slide deck per se, but it's really that arc of that story. I find that compelling.
That's amazing. You basically telegraphed my next whole segment, which is the pitch deck. How much do you care about a pitch deck? How long is too long? How short is too short? And if it's too well polished, is that a sign of a company that's thinking a little too hard about showing up to your offices to make you see a vision as opposed to that underlying metric of the business? So do you like pitch decks? Are they just a necessary evil?
Yeah, so real quick. So pitch decks I think for me, they're important because they structure the conversation. Look, if you're meeting with me and we're talking about investing, I want to know the basics of your business. That's why you're here. That's why I'm here. We're not here to just chit chat and meet each other. So a pitch deck is a very structured way to have that conversation. I think a mistake a lot of founders make, though, is they don't put their best foot forward. If you've got revenue and it's growing, you need to put that at the front of the deck. If you've got great customers, you got to put that at the front of the deck. Because most venture investors, I think it's most people, although venture investors get a bad rap, don't have a long attention span, right? You might be one of like 10 companies I'm meeting that week. So you got to punch us in the face in the first minute of the meeting on why this is a business that we should invest in. And that's, I think, the whole approach to a pitch deck. It does not need to have every single detail of your business. I'm not going to remember it anyway, right? But you got to really convince people in that first meeting why it's something great.
That's awesome.
Yeah, I agree. I do think they're important. And the way I personally think about it is like when I'm talking to a founder, like I'm also thinking about if I'm starting to like this company, how am I going to communicate this to the rest of my team? Like how do I synthesize what they're doing, why it's important to the other 4 investors on my team? How might we eventually talk to our investment committee about it? So like if I was a founder thinking about my pitch deck, I would just be thinking, how do I make it really easy for this person I'm talking to now to then go and communicate to all the other stakeholders that are sort of, part of this investment decision-making process. So that's kind of how I think about it. Like try to anticipate the questions that they would have. Oftentimes it's really the same set of questions every single time. So yeah, and then the other thing I would say, personally, I don't care that much about style. Like it doesn't need to be super polished. I don't know if it's a red flag if it's polished, but I just don't particularly care if the content is good. And as long as there aren't like objective mistakes, I do notice that. It's like, if you imagine you're working on this pitch deck for, months or whatever it is, and then you still are producing something with an objective error in it, that's like a little bit of a red flag. But in general, way more about the content than the form to me.
I have a lot of opinions about pitch decks. I'll try to pick a few. So we spend a lot of time with our companies getting them ready to raise their next round and like going through those pitch decks. And I think one of the biggest issues is that they're too long and you try to fit all of the possible questions in as a new slide and be like, well, what about our product vision on this? And what about this additional competitive slide? We have one competitive slide. And I think the intention of the pitch deck, you're not going to get a check from a pitch deck. What you want is to get a meeting or engagement or an easily shared document internally. That is the goal of the pitch deck, or to structure it during the meeting. Also, they almost always have way too many words, and actually I think when a slide has more words on it, people consume less total words of that slide because they glaze over, they have short attention spans, and at most it should be like in the high teens as far as number of slides. It probably shouldn't be less than 10 slides, but like 12 is great. And highly visual, highly like just tell exactly what it is, lead with metrics or numbers or things that will get people excited. And so I think those are the key things. I am a PDF, not a doc send. I know that's a kind of a hot take. I highly recommend attaching a PDF versus sending a doc send link that somebody has to take extra steps and friction and put their email in, and you can track every movement. That's great, but nobody wants to do that. So just a few of my opinions. Okay.
I like that we got down to the actual number of slides. 12, by the way. Ladies and gentlemen, 12 is the magic number. If you're 13, just don't send it to him. He won't take it. Okay, so product market fit, big deal. Question for you. Leading with the how, this is the lightning round again, one-word answers only. How or the why is more important to you? And if they lead with it, what does it tell you about the company itself? Big question, difficult question. Yeah, we got a pass. We got the first pass, ladies and gentlemen.
Yeah, I would say I prefer leading with the why, because you kind of just assume like we'll get to the how, but if I'm not convinced on the why, then like the how doesn't actually matter. So kind of coming back to this point of making it easy to communicate to like other team members, like this question of like, why are you doing what you're doing? Why does your company need to exist? Like that should be really, really apparent to me really quickly so that I can buy into it and then hopefully get the rest of my team to buy into it. Like the worst thing that can happen, I've seen this happen on pitches before where you're listening to a pitch and then 15 minutes in, like an investor chimes in and says, I'm sorry, I still don't like really understand like what you guys are doing or what's the real opportunity here. So yeah, I definitely prefer starting with the why. You obviously the how matters too. You want to know like what's unique about how you're actually solving this problem. How are you doing it technically? But for me, if you don't sort of sell someone on the why piece, the second part is just not that relevant.
Yeah, I think that's the easiest question. It's why. And in software at least, it's everybody can code, right? It's not like you're going to create this big moat. So it's really the why, and I'd add it's also the why now, because there's a lot of companies that they get started, but it's not clear that the timing is right. And so because it takes both, right? If you think back, even like a company like Facebook wasn't the first social network. It was like the fifth, right? But it was the now. It was because everybody growing at that, coming of age then in school, had an internet account and was willing to share information online, and that was the why now. So that's, I think, really key too.
Do you want a last bite at the apple, or are you just hard pass?
I'm not as opinionated on it. So.
More on the pitch book, less on the.
Yeah.
Okay, all right, cool. We'll move it right along. How many use cases do you expect to see in an initial pitch book? And is it ultimately it's instructive? But how many use cases in terms of like case study after case study after case study in terms of like ways things are optimized are too many for you? Like what level of the appendix do you just ignore? And what of the first 1, 2, 3, 4, 5 slides are you really drilling in on? And at what point in that presentation do you know? It's totally difficult questions only, right? We want to challenge each other here, so.
Yeah, I think the question of use cases, it kind of depends on the stage of the company. Like a lot of times I think about in the early stages, you want to see that they've really hit something with 1 or 2 use cases. And then that's an example of like something they could scale and repeat with other customers. I think if you're early on and you're kind of talking about a lot of different use cases, serving lots of different types of customers or verticals, I think sometimes that's just something to understand better. Like when I see that, I might be a little concerned that maybe the marketing message could start to get muddled if you're still an early stage company, but it's not super obvious like what use case or type of customer you're really serving. But then I guess you had a question around like in a deck, like how many examples do I want to see? I would say, 3 or 4 is probably enough for me to get my head around something really concrete. I think beyond that, I have seen decks that have like tons in the appendix. I would say in general, I don't really need that. 3 or 4 is good. And again, coming back to like being able to communicate with other people about it, I found the best way to communicate what a company is doing and make it resonate, especially if it's something pretty technical, is using that customer example. And what we do at Touchdown is actually helping corporations run their VC funds. And so particularly when communicating with our corporate partners who might not be like in the space, in the weeds every day, if I've got like some really tangible use cases, particular customers that I can explain back to our corporate partners, that's super helpful to get the message across.
I'm just in full transparency, I'm just arming this entire group to come and have like a set of, numbers, schema, et cetera, to come get you with, so, yeah.
I would say that I typically don't see too many. I typically see like 0 or 1 like example like of a customer and how they're using it. I typically see it more spelled out during the conversation of the actual pitch. Hey, like, so here's what we said, high level what we do, but this is an example. Oh, so that customer used it for this and they are getting this value out of it and they're paying this much. Okay, that's a lot more helpful, I think. And also, I think partially you don't always need so many if your description of your business is less like super high level and with a bunch of kind of like generic like kind of buzzwords, but like you really synthesize it to what's that initial customer doing for you. And so I think that maybe helps where you don't need as many examples. And then that point in the deck when it's kind of clicked what they're doing, I'm like, okay, this is pretty unique. This is a pretty great value prop. So you're kind of bought in, you're kind of cheering for that company. And then they get to the traction slide and you see that, okay, we had 5 customers, now we have 7, now we have 9, like 12, like month over month. And then you're, like that's kind of when it clicks. Like I could start I want to invest in this company if it works out. So.
You got it? Yep. Sometimes when you answer twice, you don't need the third. So I got it. All right. Now we're at the people. Key leadership qualities you look for. Key staff for every round, and then the last one will hold, but it's all about the team. So, key leadership quality in a founder. And key staff you look for, and you have various stages in which you invest, but key staff that you look for that you're going to say, oh, you have this, you've thought about this is what we need for the appropriate stage that you guys invest in.
Maybe I'll start as this pre-seed investor, and then we kind of build with the later stage. So we are looking just for some really early balance on the team. Sometimes our teams are 2 people or 4 people. 2 co-founders is probably the most common. I love it when there's the hustler and the hacker, or the business and the engineer, developer, the CTO and the CEO. I love it when you have that combo. The third person sometimes is a little bit more, if there's a third, they might be the one that's bringing a lot of industry expertise, although that's often encapsulated in the hustler as well. And so that's kind of, that's kind of what we're looking for. A great CEO founder, a great CTO founder. Of course, to put themselves to those titles that early, it's kind of funny to be a CEO and CTO of a 2-person startup, but that's what we're looking for, the initial stages of that. And so we're kind of, that's a lot of what we're judging. Sometimes there needs to be a critical, let's say it's a little bit more complicated, where there's a lot of regulatory or compliance type, a little bit more of a fintech type company. We're probably looking for somebody that understands that, or at least that's coming on board with the financing. So that's probably one of the first additions. But it's pretty rare to have a full, like a CMO or a full-time CFO. At the stage we invest, that's not very common. It could be a sign that they're a little bloated or spending too much money already on kind of overhead. So.
Yeah, I would say as you sort of get into a bit later stage, I generally think about it as starting to skew a bit more from like typically earlier stage. I would see like heavier on the R&D side, and then as you're scaling and you've got product market fit, it makes sense to go heavier on kind of the sales side. So I feel like oftentimes I'm looking at companies where they're kind of, they've had the CEO maybe kind of running sales so far, and then I would want to see them as you're getting into like Series B stage, really have somebody separate running sales. And then I would also, at that point, this is my personal opinion, but I do actually think it's valuable to have like a CFO or real finance expertise, maybe not at the seed stage, but maybe earlier than other investors might say, just because I think that like disciplined reporting is super important for managing the business and communicating with investors and just understanding how the business is actually doing. So that'd be my opinion there. And then you asked about leadership qualities too. Yeah, I'll mention one that's top of mind for me personally, just direct communication. So I've always found, and it's funny because I think you can tell this from the first meeting with an entrepreneur, if they're just really direct about where the company actually is, what their strengths are, but maybe things they need to work on. It just really bodes well for the relationship if I end up, partnering with them on an investment, because it really is, you're not just like buying a stock on the stock market and forgetting about it. You're really picking a business partner for the next 5 to 7 years. So I really like to see that evidence of just honesty and direct communication.
Yeah, those are all really great points. I guess maybe just to add to it, in terms of the qualities of that founder, it becomes, I think, really important to have them drive the culture of a business. So, I think it's really not valued the way it should be for a lot of founders, because you sort of think, hey, that's just kind of something that works out. It's something like fancy consultants talk about. But the best companies, when you get to some scale where, you may not know everybody's name, and you don't know what everybody's doing on a day-to-day basis, a lot of that glue then that holds the business together is that culture, that shared mission in terms of how everybody thinks about it. And there's no right or wrong answer on that in terms of it's not like there's this culture that works and this one doesn't, but there has to be that shared culture, and that has to come from the founder CEO. I mean, the founding team really has to really drive that, because, by the time you have 200-300 people, it's very hard then to try to implement that or something. So I think that's an incredibly important quality of a leader, especially as you get into the later stages of a business. And then to pick up on what Laura was saying about the transparency, I think just being brutally honest with where the business is, what's working really well, and celebrating those wins, but also really working on fixing what isn't working, because there's a temptation, as you get big and you find more success, you've taken a bunch of money maybe, or you at least have a lot of people working for you, it's hard to look at these challenges in a business and admit this isn't working, we need to retrench and do something different. But that's always a better decision than kind of blowing it off, kidding yourself, rationalizing. I mean, as you all probably know, human beings have an amazing ability to rationalize things. And you really have to fight that as a leader to ultimately make the right decisions.
That's amazing. When the last one is all about team. How deep do you go in assessing team culture? Obviously, Ryan, is very important to you as a part of leadership quality of a founder. How many people within a team will you ping to make sure that sort of coalescing culture exists within an organization before you'll make? So for you, maybe there's, like you said, there's a hacker and the hustler, right? You've got 2 people to go through. As it moves forward, or as there are other people in the team, how deep do you go to get a gut check or a sense before you ultimately move forward with an investment like that?
Well, I guess in the spirit of being honest, I'd like to believe that I do go deep, but I tell you, culture is pretty hard to assess.
Fair enough.
It's pretty hard to figure out, I mean, look, the market's changed, and maybe we have time to take some questions from people, but 6-9 months ago, well, longer than 9 months ago, a year ago, every deal we looked at, we had a gun to our head, and we had a week to make a decision, and we really didn't have a lot of time to do a lot of, dinners or whatever to really get to know people. And oftentimes now, companies we're investing in, they're not even, they're not based in Silicon Valley. They're here in Chicago, or they're in Berlin, or they're all over, and that makes it hard. So we have to take a little bit more of a leap of faith on the culture, and we try to meet as many of the execs as we can. But that's also sometimes tricky because, understandably, there's just not a lot of time, and it's hard to set all those meetings up and go through things. So it's a weakness.
Yeah, it should have been how deep can you go, not how do you do, right? Same?
Yeah, I really.
All right, well.
I'll just add on, for us, it's really just the founders, but we're really looking for red flags throughout the process. There's a lot of things that can kind of tip you off, and it's, one thing will sometimes, kill that deal, one kind of bad reference. And it could just be like this person was very unpleasant and hard to work with. Like we've had that before, and we're like, well, we're not going to pursue this opportunity. There's a lot of other fish in the sea. So because we know that we're going to have to work with that founder for a long time, and we know that is going to be setting the tone for the next decade of that company. So.
Absolutely. And to your point, Ryan, I think we have 15 minutes, so want to open up the floor. Questions for any of our esteemed guests. The floor is yours if we have additional questions from the audience. We got one right there.
Oh, you got a mic. Oh, perfect. Hello. Is there a specific industry or company that you feel that you kind of missed out on over the past couple of years? Kind of like year one that got away, and then on the flip side, on a more positive note, which idea, industry, or company do you feel as though you got on the forefront for, and just kind of elaborating on the highs, lows, and ones that got away?
Yeah, who wants to take that first one?
Okay, you go first. Yeah.
I think it's a great question. I think any venture investor that's been in business for a while is going to have companies that they missed. The good news is it turns out you don't get judged on the ones you miss. You get just judged on the ones that you do. So you try not to let that FOMO overtake you. There's been a lot at Storm. There's been a lot for me personally. But companies like Amplitude's a good one that stands out for me, where I had the ability to invest, and it's a long story, but we obviously didn't, and we didn't think the market needed another company like that, and when we passed. The ups and downs, I think the flip side of that is the journey these companies go on. I think when the media tells you stories, or after companies are successful, you kind of think that it's this straight line up and to the right. And in 22 years, with even companies that get to multi-billion-dollar outcomes in our portfolio, nobody has been up and to the right. There's always been some points of very, very low in the journey, and it happens for lots of different reasons. People hit a product wall, or and the customers maybe don't continue to materialize like you thought they were. A go-to-market strategy that was working all of a sudden doesn't. Some competitive dynamic comes into play, an executive team issue, founder issues. Lots of things come up. For me, there's an example. There's a company on our portfolio called Splashtop that I've been on the board now, if you can believe it, for 17 years this September. They've almost gone out of business twice. We had to bridge them once. It was probably now 10 years ago, so that they can make payroll. But today, the company's more than $100 million in revenue and generates $30 million in cash. So you can, over time, you persist, and you just keep kind of working through the challenges as a team, and amazing things can happen. The reason that every single company goes out of business is they run out of cash. Every single company, right? And so if you can maintain that perspective and keep building and keep learning and keep iterating, good things ultimately will probably happen.
Yeah, in terms of kind of investments that our corporate partners have made that I feel like we're kind of, catching a trend at the right time. One of our corporate partners is T-Mobile, and with that that partnership, T-Mobile has made a couple investments in sort of the DevOps space that are kind of motivated by the trend towards distributed microservices-based architectures and applications. So I hope that investments that T-Mobile has made there are kind of catching the market at the right time as applications move along that trend.
Ryan said that you don't get judged about the ones that you miss, but in Chicago, being a seed investor here, we were asked, like every LP was asking us why we were not in Cameo for the past 4 or 5 years, and we passed on Cameo. We didn't think it would sustain, and maybe now we'll see where it kind of ends up, but like we were kind of judged on that, and it hurt because we just didn't think it was a good idea, and we passed, and so that's probably one. The one that's on my mind that we kind of were kind of ahead of the curve is there's a kind of a data infrastructure company built on Apache Airflow called Astronomer, and we invested in that back in 2016, and it wasn't a smooth ride though. But now it's one of the first unicorn companies in our portfolio, and being a seed investor, that's a pretty big markup for us at this point, and so. It was something that we wrote a thesis on and had to kind of really stick our neck out for, and then it has paid off. But it's being a pre-seed seed investor. You really have to try to predict what's going to be the most fundable type of company 24 months from now, and that is kind of a tough journey and slog because you win biggest when you're right 24 months from now, but right now you look kind of wrong or not, and that's when you win biggest. So you have to make some of those bets.
Got a question, several questions, right in the middle.
Yeah, we discussed that what you look for in the company in terms of leaders, the team, and everything. So my question is, whenever any VC approaches the company or they approach VC, as a company, what they should look for in the VC? So because money alone is not enough, right? So is there any criteria, any advice that you would like to give to companies like those who are being approached by the VC, or they're looking for funds and they are approaching VCs? Thank you.
I think we'll all have kind of unique things to say, but the nice thing about VCs is that they have really aggressively built out different value props, and so most VCs they'll be good at something. Maybe it's an industry. Maybe they are super well connected in a specific field, or they used to run a function at a couple different startups, and now they can really help you with sales or ops or something. We've really leaned on helping companies get through a large network approach to raising capital, hiring talent, and kind of expanding a founder community. So that we think that's helpful, but we're not as good at. If you need industry expertise in a specific industry, we're not going to be as good at that. So I think you can ask them what their value prop is, and then be like, is that what I need right now? Maybe even have in mind to the VCs you're reaching out, I need this type of investor. And you can also kind of pull together different types if you have the interest and ability to bring, this person's really good in this industry, and then this one has strategic connections here, and then this one has just they've helped companies scale before, and then I'll take in an angel investor as well that specifically is good at this function, and then you kind of piece together a pretty interesting cap table. But the number one thing is, then when you get towards the finish line, you get a term sheet or getting close to that, referencing that VC by talking to some of their other founders they've invested in or sat on the boards of, and validating what they say, and also just making sure that they've been a great partner over the years.
Yeah, I agree with all of that, and I'll also just add from the perspective of corporate VC. So at Touchdown, when we talk to startups, sort of on behalf of our corporate partners, I'm often trying to prompt the startup or the founder to think about would this make sense to you to partner with whether it's a T-Mobile or another partner we have. Kellogg's, Allegiant, we have a number of corporate partners in different industries, and we're always looking for companies where we feel like that corporate could really uniquely help the startup. And I always would push the startup founder to ask themselves, do you really see the value in this versus just having an institutional VC who maybe doesn't have like those same like strategic elements that they can offer. And so I agree. I think piecing together like a complementary set of investors can make a lot of sense because institutional VCs bring things that a corporate investor may not be able to. So I would just recommend thinking through like how could a strategic investor really help you with your go-to-market, your technology development, whatever it is, and how could they be a good complement to other investors that you work with?
Yeah, they're all good points. I guess what I would add to it is I don't think enough founders diligence their investors and really know whether they can deliver on the value propositions, if they've done that in the past, what do they like to work with. There's some miserable people that are venture investors. Miserable. I mean, you wouldn't want to do business with them. And they may even appear very successful. But the thing is, when you take money from a venture investor, they're going to be on your cap table forever until you sell. There's this old trope in venture. It's like it's worse than getting married because you really can't get divorced, right? So, and it can become a lot of overhead as a founder if you've got this person that's on your board, on your cap table, who insists, I don't know, on meeting you every other week or calls you every other day to get an update on things and then complains that you're not doing it, just not constructive. So, I would say just do some diligence on the investors. You really should. I mean, ultimately, we're a service provider. And you should, that chemistry is important because you're going to work with your investor, hopefully, for a long time.
You only call them 4 times a week?
Yeah, just 4, sometimes 5. Yeah.
That's 7 days, so you get some days off with Ryan.
I would also add that, a lot of these guys are communicating the types of investors that they are. They have podcasts. They have a whole bunch of, blogs that they produce that give you a lot of information. I know you have your own Ask a VC podcast, right, Ryan? And so, you're telling the world every day things that are important to you, things you look for, metrics, et cetera, things that are interesting to you about what's happening in the marketplace. And I think those are also really effective tools, like you said, to diligence.
I mean, I think it is really important to look at what people put out there because I think investors do put a lot more out there today about who they are. But I think it's really important to check on that stuff because I think there's a lot of people that give a lot of bad advice in venture. And so talking with other founders, looking at the successes, and really understanding, how fundamentally solid is this person, it's critical.
Truly trust but verify.
Yeah.
We had another question in the center.
Hey, thanks for the panel. Just a quick question. How do you find companies to invest into? Do they approach you, or you find them, or how it works?
Yeah, I can start. Kind of all of the above. So a lot of times, from seeing what we put out there on our website, social media, et cetera, startups will find us. We also do a lot of proactive sourcing at my firm. So basically, once we've determined focus areas that we're interested in, just go out and look and find companies look interesting and try to, the best practice is generally trying to find someone that who might be able to introduce you to the company, to get connected that way. And then I would say one of the best ways is just getting connected through other VCs. Like you get to know other investors and you come to know each other's themes, like what you're looking for, and then we share deal flow across different firms. So that's often sort of the best source of deals, I would say.
Yeah, founders are one of the biggest ones. Like our portfolio, we have 130 companies, and we probably get our largest number of really qualified opportunities from our founders and then our co-investors, and then sometimes other service providers in the industry. We have invested in people that have reached out to us cold. Usually, 99% of cold emails are really poorly and targeted and mass written and bad, but we've had, I think, 3 out of the 130 that we've invested in that from a cold email, and that was really well, it hit our thesis, and it might take a little longer to diligence or get to know, but we have done that too. So from our website or from they just found our email or reached out in a cold way. So.
Yep. We got any other questions from the crowd? If not, I know we got time for 1 or 2 more. Yep, in the center up front. Right up front, right center.
Hello. Can you share an example of a wrong investment decision and what was your biggest takeaway from it?
Airing the dirty laundry.
Ooh. This might be a good last question. Who wants to? Do you want to? So, an example of a poor investment decision and what you learned from it. Poor investment decision. Probably something that didn't go quite the way it was intended. Maybe was the way I would spin that one, right?
Yeah, I could. Maybe I'll give one actually like really starting my venture career. I just made a personal angel investment, and so it's just interesting looking back on it now. I don't actually know. I can't say if it will be a failed investment yet, but I'm kind of feeling like it might be going that way. But looking back on it now, having done this professionally, I think I just learned all the things that you need to do to really diligence an opportunity. And I think I made that decision pretty quickly, which was just kind of the nature of the opportunity. But I think I just learned, with that one in particular, the company was in a pretty crowded space. So I think, again, I made the decision quickly, but in retrospect, would have just spent more time understanding, like, okay, what is really different about this company versus everything else that's out there? And would have just spent more time looking at what else is out there. And then I think maybe that would have given me pause on investing in this particular company.
I'm thinking of a couple examples where we moved too fast, kind of driven off of FOMO, and made an investment decision that wasn't, in hindsight, it was a bad, like it has been a bad decision. At the time, just kind of, maybe like, okay, well, let's assume this, making more assumptions or moving faster, not doing all of the, the checks that you might normally do. So, that'd be interesting.
I'll give one category. Actually, it's relevant to SignalWire. So voicemail used to be a thing. I don't know if anybody even uses it anymore, but it used to be a really big deal because that's how everybody talked, was calling the phone, you leave messages. And we backed a company probably 18 years ago now called Adomo that was building a new voicemail server. And I think it failed miserably, and for a bunch of reasons, channel issues and so forth. But I think the big lesson we took away from that was the capital required. So we have a relatively small fund. All of our funds have been $200-300 million, and in the world of venture, in today's world, that's not a very big fund. So we can't write $15-20 million checks. And if you're an investor in a business that requires a lot of capital over time, and you can't write a meaningful check unless things go perfectly, you could get caught out. And that's what happened at Adomo. It was very expensive. The salespeople were expensive. The engineers were incredibly expensive. It was a very heavyweight system, and we just couldn't get it to really take flight despite having some revenue. So we're much more thoughtful today going in around capital required, not just capital efficiency, but capital required. Like, we would never do an Uber. We looked at YouTube. Someone asked a question earlier about, deals that got away. We looked at YouTube. We could have done it. We could have done it on Pinterest. But we didn't do YouTube, I remember, because YouTube was literally lighting dollar bills on fire. I think that year they got acquired, they consumed like $300 million of capital, which back then was a lot of money. And I'm not sure any venture firm other than Sequoia could have pulled that off, because they had to get so many other investors to come into that and fund it. So yeah, it's been a big lesson for us.
All right, well, we're at time. I just want to, more than anything, say thank you guys so much for the time, for the insight, and really, really appreciate it. Thank you so much.
Thanks, Evan.
Have a wonderful day. All right. I imagine everyone's peckish, so lunch is upstairs, and we'll convene back here for the afternoon session just after that. Hey, thanks, man.
Thank you.
Appreciate it. Excuse me, yeah. So I don't miss. Upstairs, the VCs will be in Currents, and if you have more questions or want to follow up with them individually, they'll be up there for the lunch as well. Also, to note, Homer has its lunch and learn, and that is, let me get it out, in the lounge, in the SignalWire lounge, and that begins at 1 p.m. So the Homer Lunch and Learn is in the SignalWire lounge starting at 1 p.m.